This is part 3 of a 6-part series going through how to calculate and how to prepare the Mike Company budget, master budget. So we start off with the proper heading. This is the selling and administrative expense budget, and it is for the first quarter. In part 1 of the selling and administrative expense budget, which is a little bit differently from the way the textbook does it, I like to separate out all of my variable and fixed costs. Because we're going to be doing a contribution margin income statement, you need to have variable and fixed costs separated. It is appropriate to do it here, which makes doing our income statement that much easier. So in part 1, I'm going to list off all of my variable costs. Now if you go to the Mike Company budget problem, we're looking at part number 6, 7, 8, 9, 10, and parts of 11 to help us do this budget. Number 6, it says the company pays its sales force a commission equal to 5% of sales. By definition, again, you need to be able to identify this as a variable cost. It changes proportionally to changes in sales. So the commissions expense is 5% of sales. If you look at point 7, it says the company also believes that its supplies expense is equal to $1,000 plus 1% of sales. With that identified, hopefully you identify that as a mixed cost, meaning there's both a fixed and a variable component to this cost. Well, if we're going to separate out our variable and fixed costs, we're going to list off the variable part of supplies with the variable cost. The variable part is 1% of sales. And that will identify all of our total variable costs. So to calculate the total commissions expense for January, let's make the proper headings. We're going to say 0.05 or 5% times January's sales. February will also be equal to 0.05 times February's sales. And of course, you can simply copy this formula over and it will automatically change things over. With supplies expense, it's equal to 0.01 or 1% times your credit sales. And you can copy this formula over. So your total variable costs are $6,600 and $7,620 for January, February, and March, respectively. In part 2, we're going to list off all of our fixed costs. Our fixed costs include, of course, the fixed part of supplies, the $1,000 a month. If you look at part 8, it identifies that we have rent as a fixed cost, advertising expense, we have depreciation expense, we have utilities expense. If you look at point number 9, it says that the company purchased an insurance policy covering 12 months for $12,000 on January 1st. That process would have created a prepaid insurance. Using that insurance would create insurance expense of $1,000 a month. Point number 10 tells us how we actually pay for all of these selling and administrative expenses, which is not really important to part 2. It's going to be important to part 3, which we'll get back to. Point number 11 is actually going to be needed to do part number 2, because it says that on January 31st, at the end of January, Mike Company purchased some new equipment costing $20,000, paying cash. Purchasing new equipment, that's not an expense. But, as you know from Accounting 101, equipment has to be depreciated. The depreciation of that new equipment is an expense. If you read further, it says Mike Company will begin depreciating the asset in February with monthly depreciation equal to $1,000. So this new asset was going to be depreciated $1,000 a month beginning in February. And again, in parentheses it says in the Mike Company problem, this means depreciation expense will increase by $1,000 per month due to the acquisition of the asset. So there'll be a step up in depreciation expense beginning in February, where it goes from $5,000 in January up to $6,000 in February and March. So let's go ahead and calculate our fixed costs. The fixed part of supplies is $1,000 a month. It'll be the same every month. Rent expense is $2,000 a month, and it will be the same for all 3 months. Advertising expense is $1,000 a month, and it will be the same for all 3 months. Depreciation expense is $5,000 in January, but because of point number 11, there's going to be a step up in depreciation expense, and it's going to go to $6,000 in February, $6,000 in March. Utilities expense is $1,500 a month for all 3 months. And the insurance expense, you're going to use it $1,000 a month for each of the next 12 months. It's $1,000 a month. So my total fixed costs are $11,500 in January, $12,500 in February and March. In Part 3 of your Selling and Administrative Expense Budget, you actually show all of your cash payments for all of your selling and administrative expenses. So I'm going to list off all of the expenses, even though I know, for example, depreciation expense is non-cash. I list it personally. You don't have to. I list it so I make sure that I don't miss something. So I've listed off all of my various expenses. Now I have to identify how I actually pay for these things. So how do I pay for commissions expense? This is where we go back to point number 10 on the Mike Company budget. It says all selling and administrative expenses are paid in the month they're incurred, except for commissions that are paid the month after they're earned by the salespeople, and the insurance, which is paid 1 year in advance. So commissions expense, this $5,000 will be paid the month after it's incurred by the company. So this $5,000 will be paid in February. This $5,500 in commissions expense won't be paid until March. So what is paid for commissions in January? Well, it relates to December's commissions expense. So where do we find that? It's an expense that has been incurred but not paid yet. If you look on your beginning balance sheet, you'll notice there is a balance of commissions payable, and that is the amount that gets paid in January. Supplies, if you remember supplies, we had both a variable and a fixed component of supplies. We just have to make sure that we include both the variable and the fixed part of those costs. We can copy that formula over. Rent expense will be equal to $2,000 a month. Advertising expense is $1,000 a month. Depreciation expense, it is a non-cash expense. You don't ever pay anything for depreciation, so it's zero. Utilities expense is $1,500. Again, I'm just simply copying that formula over. And insurance expense, how is it paid? It's prepaid 1 year in advance. So in January, we're going to pay $12,000, and we're not going to pay anything else for the remainder of the year. So our total cash payments in January are $22,667. In February it's $11,600, and in March it's $12,210.